Hello, my name is Dave Zapponi. I'm the CEO of ECHO, which is otherwise known as the Educational Council of Homeowners. I want to thank everyone for participating in today's community conversation, HOA taxes and other accounting conversations. ECHO is a 50-year-old statewide nonprofit association established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connections. For today's event, we have a few housekeeping items. These are now presented on the screen. This slide was sent to all registered attendees. Please take a moment to review our housekeeping items. Today, we have a large audience of HOA board members. We will do our best to answer your questions, but we may run out of time. At the prerogative of the presenter, he may answer questions during the presentation or only during the Q&A session. To try and answer as many questions as possible, I may write answers to your questions in the Q&A feature as well during the presentation. We will do our best to respond to as many questions as possible. Unfortunately, we often are unable to respond to everybody's concerns or questions. We use the voting feature in the Q&A feature to prioritize questions during the Q&A session. Please vote for your favorite question by using the thumbs up button. Those questions with the most thumbs up will likely be chosen first. Also, please keep your questions general in nature and short. We may pass over some questions if they're too long or they're too specific. Specific questions about your community are best asked of your attorney or another appropriate expert familiar with your situation. Please use the chat feature only to report technical issues and to communicate directly with other participants in the webinar. We do not monitor the chat feature for questions. Now, let me direct your attention to your monitor where you will find our disclaimer. None of what is said during this seminar shall be construed as specific legal advice or expert advice from the speaker, sponsors, or ECHO. If you wish specific advice, we encourage you to contact your attorney or another suitable expert. The information we provide during this webinar is educational in nature and should not be relied upon for specific decision-making purposes. Thank you. This webinar and all our events are made possible by the generous support of ECHO HOA professional service providers. Please join me in thanking today's program sponsor, CM Squared, and registration sponsor, Levy, Erlinger and Company, LLP CPAs. We will now hear a brief word from Annie at CM Squared. Connor?
Hello, ECHO members. My name is Annie Weiland, Vice President of Client Success with CM Squared Construction Management. We help the board of directors manage their construction project. We are not a general contractor. We serve as a third-party consultant to protect the board and the association. We do this by developing the scope of work. We put together any architectural or engineering details that may be needed for permitting. We obtain competitive apples-to-apples proposals from the general contractors, and then we oversee the project from start to finish. That includes handling any of the financials as well as communication. Some of our core services include deferred maintenance property assessment. If you have an older association with limited funding and you're doing Band-Aid repairs, we can come in and do a full property assessment and help you prioritize what repairs to do based on your reserve study. We also have an in-house reserve analyst, therefore we're able to provide these reserve studies. We have an in-house roofing expert who does a lot of roofing consultations for associations. We focus mainly on exterior envelope repairs, so that's decks, paint, dry rot, stucco. We perform construction defect repairs, as well as having in-house architectural engineering. Therefore, we can provide the SB 326 deck inspections, as well as assist with the repairs. If you need any of these services, my email address is annie@gocm2.com. That's ANNIE@GOCM2.com.
Okay, well, thank you very much for that. And we appreciate the support of Annie and CM2 for their help in providing this educational forum today. Please support all ECHO professional members and especially our sponsors. They make our educational programming possible at little or no cost to you. And now on with today's program. Bill Erlinger received a Bachelor of Science degree in accounting from the University of California at Berkeley. His MBA in finance from Boston University and a Master of Science in tax and a tax degree from the California State University, Hayward. Bill's thesis was on the taxation of homeowner associations. Bill is also an active member of ECHO, including former chair of the CPA Resource Panel and a contributor to the ECHO Journal and ECHO Insight e-newsletter. I want to thank Bill for coming today. Go ahead, Bill, and take it away. Appreciate your time.
Thank you, Dave. And thank you all for joining this webinar, and good afternoon. If there's any technical difficulties, I'm going to apologize in advance. I'll try my best. I now have control of the slides, and we'll see how this goes. So progressing. Wow, I'm impressed. Okay, the start. We have a question, and it's: have you checked the corporate status of your association the past year with the Secretary of State? And if you want to do it right now, you can see at the bottom of the screen, it says bizfileonline.sos, and that would be the place to go if you want to check on the corporate status of your association. So given that.
We'll give them about 15 more seconds here, Bill.
Thank you. So the answer is yes, no, or unsure. You would have asked me, what does this have to do with income taxes? Well, stay tuned.
Okay, I'm going to go ahead and end the poll now and share it on screen.
Okay, good. So the poll results is that it's only have checked lately. Well, is that good? Probably should be done annually. So I closed that, and then let me move on. This is, I've got a table of two associations here, so you can see what you should be looking at when you go to the Secretary of State's website. This is the good association, Pine Terrace, and you can see I highlighted it says standing FTB, good, and that's what you want to see, because we'll talk about the meanings of good and not good in a moment. So this one's in good. Another thing you can look at, it was on the prior screen, it's to check whether your corporation or your association has exemption from the franchise tax. If you want me to go back to the screen for a minute, you can see at the bottom it says webapp.ftb.ca.gov. That is where to see if you have exemption from franchise tax. So here on this, the good association franchise tax highlighted exempt status, it says exempt. So, oh, thank you. Oh, I've heard those issues before about possibly my mic. Thank you. This is an improvement. Next slide. This is the Apple. That's a pun. The Bad Apple Association. You can see here it's understanding FTB, and on the status line it says suspended. FTB suspended. So that means, we'll talk about what that means in a second. Let me try, well, let me try this. Taking off. It could be the headset that was the trouble. So let me, if it is, or it isn't, let me know how it's going. So, okay, here's the not so good association. And you can see here, standing FTB is not good. And here above it, status lines suspended FTB. Its exempt status is also lost, it says not exempt. Okay. Thank you, Steve. Better. All right. So here's go to the next slide. What did I mean when I said the corporate status is suspended? And it means, now I'm not giving legal advice. You really need to speak with your legal counsel should your corporate status be suspended. In general, is your association, if it's incorporated, and most associations are, it means that you cannot conduct business. You cannot sign contracts. You can't go to court. And what gets everybody's attention, through did, is that if they ever find out about it, they'll close your accounts. They'll tell you they can't do business with a suspended corporation. So if none of these can get your attention, I don't know what could. So, okay, next slide is, if your corporate status is suspended, the first thing you ought to do is call your association CPA. That this is not I'm only telling you this, meaning that that is for the best for your association. So, oh my God, I'm sorry that the audio's not very good. I don't know if that's at my end.
Bill, do you have a speakerphone at your desk?
Oh,
Because maybe we'll have you just try and call in and see if that helps with the sound.
I can hear you, Connor. Do you want me to do something?
Yeah. Do you have a speakerphone at your desk that you may be able to call in with?
Let me try. Okay. What number should I call?
Get it for you. See here. For this meeting, it will be 669.
1669. All right.
Yeah, 1-669-900-6833. And then it should ask you for a meeting passcode or a meeting ID.
What's the meeting ID?
Meeting ID is 863
863
0805
pound.
No pound.
Eight 863-0805 doesn't. What's the number again, please?
Be that number right there.
Whoops, it just hung up on me. I'll have to.
Here, Bill, try Martin's suggestion in chat here. Go ahead and turn off your camera and see if that
Want me
maybe
to turn off my camera?
yeah, you may be using too much bandwidth.
Okay, let's try stop video.
Yes, that's correct.
Okay, how's that?
Oh, you sound good now.
Well, maybe I can put the headset. Forget it. Okay. All right, so we'll keep going.
Yeah, you sound a lot better now, a lot more clear.
Thank you. All right, so apologize for the technical difficulties and moving on. So the first call when you find out your association's corporate status is not in good standing is your CPA, and your second or your first call, if you're one of those kinds who like to do things yourself, you have to call the FTB, and that's the exempt unit, and the phone number's on. They're open from 7:15 a.m. to 4:15 p.m. Monday through Friday. And all you merely do is identify yourself and give the California corporate ID number to them, and they'll tell you why corporate status is suspended. And there's two reasons. Enough. Tax returns weren't filed, or money wasn't paid, and they'll tell you what's what, the reasons for it, and how you can cure it. And there's then arriving homeowner. Oh my. The very good.
Yeah, you're dropping a lot now, Bill.
Darn, I don't know what your suggestions.
Let's see. Sign language. Thanks, Carol, for the. Okay, let's see. I think we should go ahead and try with the phone. Yeah. Like Angelica is saying, let's try dialing in again.
So 1-669-00
9006833.
1-669-9006 8. What's the meeting ID, please?
The meeting ID should be 863-805 or 0805.
Oh shit.
My bad. Sorry about that.
What's the number again, please?
863-0805-2097.
2097. What's my participant ID? Or just press it?
For you, it will be.
What's the meeting password?
I'm grabbing yours. Passcode is 539997.
2 9s and a 7.
3 9s and a 7.
I've been muted.
What is your landline's number, Bill?
415-233-8622.
There you go. Try that.
So I just talk in the.
Yeah, try it one more time.
But I talk into the handset.
Yes, so you'll just talk into the phone, or if you have it on, or if you want to turn it on to speaker.
Right, and put it on hands-free. Although, do you hear an echo?
Nope, I muted the other mic.
Oh, I hear it, but okay. You can hear me? Very good. Thank you. This is weird. Okay.
Do we want to go back a couple slides for the ones that had garbled audio?
By Joe, I think we got it. Okay. So here, we'd start out by, thanks, Suzanne. I appreciate your comments. Okay, we talked about corporate status is suspended.
consequences. That a corporation can't conduct business, can't sign contracts, can't go to court, and the bank can close out your accounts. They'll give you, I don't know how much time to fix it, but you're gonna have to fix it. Okay, then to do if your corporate status is suspended. First place is to call is your CPA. That's not a public service announcement. You should call them, or call if you like to do things on your own. You call the FTB's exempt unit. Phone numbers on the screen. You should write it down. You call them. You should call them. Just identify yourself and give them the California corporate ID number, and they'll speak with you. I've heard that recently there is a firm that specializes in trying to revive HOAs. And don't ask me their name. I think maybe if you do an internet search, you'll find them. But that's a new thing. Generally, you're going to have to file back tax returns. You have to pay some balances due, and you're going to reapply for exemption. Okay, ready for a polling question? When you are asked by your bank or a government agency or your next door neighbor, if your homeowner association is tax exempt, what are you going to tell them? Yes? Oh, maybe I need to ask my manager or my neighbor, or I don't know, I need to ask my manager or my accountant.
About 15 more seconds. Okay, and here are the results on the screen, Bill.
Okay. Well, as most of you think or believe that your associations are tax exempt. I'm only the messenger, but you are not. You are not tax exempt. You are not a nonprofit. Sometimes you might be called, you can call quasi nonprofit, but that's so out of the way. Just think of yourself as you are not a nonprofit, you are not tax exempt. And if you keep that in mind, you're going to mostly come up with the right answers most of the time. Okay, thank you for participating. Now, if your association loses its exemption, what does this have to mean to you? It's not a catastrophe. Not what you think. It's not that you're going to all of a sudden have the IRS or Franchise Tax Board take all the association's reserve money or some other kind of disaster. The only meaning that it has is that your associate, well, it's not the only, but the primary meaning is that your association is now going to be subject to the $800 a year minimum tax. Doesn't sound so catastrophic, but I understand no one wants to pay the $800 a year minimum tax. Oh, I don't know where this came back. So the usual route to redemption is you have to reapply for exemption. And reapplying for exemption is that you have to negotiate with the Franchise Tax Board. If you haven't filed tax returns in a long time, even though they may say initially that they want tax returns back from the year you stopped filing, in the year 2000, say, they'll want 23 years of tax returns. You can negotiate with them, better to let your CPA do the negotiation for you. And oftentimes you can settle on 5 years of it sounds like a reasonable amount of time to file back tax returns. Notice I didn't speak about the IRS. That's because the IRS really is not a major player when it comes to the taxation of homeowners associations. not at all like the franchise tax board. Next slide. Checking on that. As I said, is your association nonprofit, tax exempt, one versus the other, and what are you? And as I said, homeowner associations are not nonprofits, and they are not tax exempt. I say if you keep that in mind, you're going to be right almost all the time. The associations do pay tax on is, we call it non-member income. And by that, I mean, the usual is bank interest. I didn't say interest from late assessments, only bank interest. Comcast easement income, if you're lucky enough to have that, or cell tower rents, if you're lucky enough to get that, or rental income from any association-owned property. But I think you might get the general idea of what you mean by non-member income. Likewise, assessments, special assessments, late fees, interest, and other member income are not taxable. This is on the Form 1120. I'm not going to really talk very much about Form 1120H. So on Form 1120, that's the federal return, member income such as assessments, special assessments, late fees are taxable. Now, what you can deduct against the non-member income is pretty limited, and it's limited to those expenses that are directly related to the production of taxable income and the fee to prepare the tax returns. So you can see there's some benefit for the homeowner association paying the CPA to prepare the tax return. Get a deduction out of that. Any applause? So speaking in general, very lightly general about homeowner association taxes, on Form 1120, that's the federal form, members approving revenue ruling 70-604 allows a homeowner association to pay less tax rather than not making the election and using Form 1120H. This election, the 7604, why it's called 70-604 was because the IRS issued this revenue ruling in 1970. So we can talk about 50-something years ago, and it was the 604th such ruling in that year. Okay, so it's that the members must make the election. Doesn't matter what you put in your governing documents. It doesn't matter what the board of directors say or don't. It has to be made by the membership, and it must be made each year. Now, it does not necessarily have to be at a valid or a legal member meeting. It could be any meeting where as members, it's designated to be a member meeting. You don't have to have a quorum, but the vote can be accomplished by a ballot, a raise of hands, or a voice vote. The voice vote being all in favor, say yes. And on the next slide, we'll see some sample wording. It's not copyrighted. Please use it. So the wording I suggest you use when making that election. On Form 1120H, while no revenue ruling election is needed, the tax rate is 30% of something similar to net non-member income, not 21%, which is the tax rate on Form 1120. Also, the tax base, what I mean by the tax base, meaning that what income is subject to tax is much broader on Form 1120H, meaning there's much more kinds of income that are subject to tax on Form 1120H. Some examples, and there's differences of opinion, of course, but some examples would be laundry income, late fees, interest on member assessments, late assessments. If you do an internet search on revenue ruling 70-604, and probably some of you are doing it right now, but you'll see that there's some sort of controversy, and it's kind of humorous that there's controversy in a bunch of tax accounts. But the controversy primarily has to do with whether or not this election can be made each year or not. And I have the opinion that it can. And you look on the internet, you'll see opinions that are different than that. Here's the sample wording to use when you make the election. and you can see that it's very general in nature. You don't say that for any particular year, but you don't want to paint yourself into a corner when you're making an election like this. Right, so then we're moving on to another subject here. It's also that time of the year, maybe your associations are already, not already, talking about budgets. What's the budget going to be for 2024? We're not going to go in detail about budgeting, but I just have some suggestions that maybe you think about when you're working on your budget. One of them is not to forget about those owners who don't pay their assessments. Because if you budget for it, you don't collect it, you're not going to come up with enough money. So you just have a line item in your budget for uncollected assessments. Decide how much you shouldn't put in there. Another tip to think about is the deductible on an insurance claim, because very likely you'll have an insurance claim in the year. If you don't budget for the deductible, again, you also find that you're a little short in cash at the end of the year. Now, one of the interesting discussions would be about where you budget. Do you budget for income taxes? Some like to budget for them, and some will talk about why they don't budget for them. It depends whether you're going to treat those income taxes as an operating expense or as a reserve expense. I'll repeat that, is an operating expense or a reserve expense. It could be a board decision that they want to pay all income taxes out of operations. There's nothing that says it has to be that way, but you could, or you could say that all income taxes will be a reserve expense, so pay it out of reserves. Take a look also at your reserve study and look at what the reserve study preparer, how they treat reserve interest. They might say it's net of income tax, or they might show it broad and they'll show a line for income tax, but they won't show income taxes at all. It doesn't mean that you have to do it that way, but it just is, you want to be consistent with it, you could do it that way. So if you budget for it in operations, then that's the right thing to do. Then you're going to pay it in operations. But if you were going to budget for it in reserves, don't put it in your budget. In other words, don't budget for income taxes if you're going to pay it out of reserves, because it's not just like you don't budget for the roof work or the painting that you're going to do in reserves, because it's a reserve activity, not part of your budget. What goes into reserves is a reserve contribution. So as a tip, if you don't want to pay income taxes in operations and pay from reserves, then don't budget for it. Likewise, though, do not budget for the reserve interest, because you can't take the reserve interest to offset your operating expenses. Put it in your budget, you're going to definitely come up with a negative at the end of the year. You didn't have enough money in reserve in your operating account to pay for the operating expenses. So don't budget for the reserve reserve interest. Okay. Now, the reserve contribution is always a spot, and I'm not going to try to pick on anyone here, but many use the reserve contribution as a way to manipulate. That sounds a little shady, but it's often used as a way to manipulate how much a budget increase you should have. In other words, if your operating expenses go up, or you projected that they'll go up, and you don't want to increase assessments, then you take it out of the reserve contribution. That's just not generally a very good idea. When you need to discuss with the reserve study preparer how much you're going to put into reserves. And the budget and the reserve study need to show, or should show, the same amount going into reserves. So if the reserve study says that you're going to put 50,000 in reserves in 2024, then that ought to be what's in your budget. If you're not going to do that, then the reserve study ought to show what you're actually going to put in. You can put yourself in some angry owner's position, that if the reserve study says you can put 50,000 in and your budget says only 20,000, then it appears that you didn't follow the advice of your paid expert, and it leaves the question but about the board's ability to budget and plan for reserves correctly. Now, a topic that's near and dear to me, maybe not to you, but I'll explain it in a moment, as is called the division of assessments. And that's another way of saying calculating the per unit per month, or PUPM. Many of you think this is no big deal whatsoever because everybody pays the same assessment. Not every association is like that. And the reason this gets to be complicated or difficult is the 20% rule. And as a reminder, the 20% rule says that the board of directors cannot increase assessments more than 20% without a vote of the membership. But there's some other conditions, but namely we'll talk about the 20% rule. The 20% rule applies at the unit level, not at the association level. It doesn't matter if everybody's going to pay the same assessment. So if the association's assessments go up by 20%, then everybody's assessment is going to go up by 20%. Okay. Same goes with the next one. If everybody pays on a variable percentage, meaning like the large units pay, if you got 10 units, the large unit pays 15, the small unit pays 15%, the small unit pays 5%, something like that. So if the association's assessments go up by 20%, then each owner's assessment would also go up by 20%. The next two methods of division of assessments where you're not going to get that kind of result, meaning that if you increase assessments, let's say 10%, some units are going to go up by more than 10%, and some units go up by less than 10%. So if you're increasing your assessments by at least 15 to close to 20%, and you have a division of assessments under the mixed or super mixed method, odds are pretty good that somebody's assessment is going to go up by more than 20%. So if your assessments get divided on the mixed basis, where some expenses are divided on a percentage basis and the rest equally, that the usual way is that the CCNRs will say that operating expenses such as water and gas and insurance and reserve expenses such as painting and roofing, those get divided on a percentage basis. Everything else is divided on an equal basis. And there's some CCNRs, let's hope it's not yours, there's some that I call super mixed. And that's where the governing documents attempted to identify every expense of your homeowner association. And each expense is to be divided either on an equal basis or on a percentage basis. And that was, well, if your governing documents are like that, you should have your CPA do the preparation of the per unit per month. Because if it doesn't come out right, somebody paid more and somebody paid less than they were supposed to. You can imagine the people that paid less won't say a word. The people who paid more are going to be unhappy and upset, and they're going to want a refund of their overpaid assessments. Some other budgeting items, and many associations do not have parking assessments, but those that do, you need to look at your governing documents. How are those assessments determined? Sometimes it's a fixed amount, other times it's done in the same way that regular assessments are determined, where some expenses are allocated to the computation of the parking assessment. Lastly is something that comes up, it's the question on, do the budgeted revenues have to equal budgeted expenses? You got to put that as a polling question, but no, they don't have to. There's nothing that says it. There's no law, there's nothing, David Sterling, there's nothing that says your budgeted revenues have to equal your budgeted expenses. This is not a city government and it's not federal government, all we know that they don't exactly have revenues equal expenses. But what do you do, or how can you present that to the owners, or how can you discover or think about how could you have revenues and expenses not equal each other? Well, the first way to look at it is if revenues are more than expenses, you could run into trouble take a look at California Civil Code Section 5600, it says that you shouldn't be budgeting for expenses that you don't have. So if you're showing revenues more than expenses, it implies that you're collecting more money than you need to. So you can figure out how to address that. It's when expenses are more than revenues, and they could be. Why not? How could you present that to the owners so they don't, not only owners, but also lenders, so they don't lose sleep? What you should do is under the revenue section of your budget, you put a line that says prior year surplus, or could say carryover surplus, or something like that. And you put an amount in there so that revenues will now equal expenses. There's no trick, no smoke and mirrors, there's nothing wrong. What you're doing is you're saying you're going to have a deficit. And that deficit is going to be funded by surplus money that you have in the operating bank account. Of course, if you don't have that money in the operating bank account, you can't do this. So if you do have the surplus in your operating bank account, then you could utilize that surplus this way. And the surplus probably got there because you did the revenue release 70-604 election, applying excess assessments to the following year's budget. And just to kind of off the subject slightly, a good rule of thumb is how much money you ought to keep in your operating bank account is 2 to 3 months of operating expenses. Unless you anticipate, let's say you have earthquake insurance, you need to build up a bunch of money to pay the premium, then you don't quite apply the 2 to 3 month rule. But on the whole, 2 to 3 months of operating expenses in your operating bank account would be just about right. You have less than that, just like in your personal banking, if you don't have that much money in your bank account, it's highly stressful. You can't pay bills on time. And we all know about that. Talk about the internal accounting rules, controls, just briefly. And here's another polling question for you. Do you or another member of your association look over your association's check registers each month? No one's gonna, this is an anonymous answer, so don't be worried about it. But do you look over your association's check registers each month? Yes, no, or you're not sure?
About 15 more seconds, Bill.
Thank you.
And here are the results.
Hope it's all yes. Very good. 71%. You should all be pat on the back. Congratulations. Good deal. That's an excellent control. And for those 14% that aren't, you got to consider doing it. Some other kinds of internal control, and you might not think of it this way, is the monthly actual to budget financial statements that you get. You should look at actual expense compared to your budget expense. And usually the budgeted expenses is the annual expense divided by 12, and that's the monthly expense. So you can compare the actual to budget, and you ought to get an understanding as to why it's more or less than budget. You ask one another, you can ask your manager. But if you're concerned and you don't understand something, you got to ask about it. And here it is. If your actual expense is a lot more than budget, that's telling you something. Why? You got to ask why. Another kind of internal control is relying on the new software that most management and accounting only firms are using, whereby that board members have access to a portal, and in that portal, the list of invoices that to be looked at and approved. So the invoices won't get paid until whatever the protocol you set up. So however many board members looked at the invoice and approved it for payment. So here's another opportunity to take a look at who's submitting an invoice for work performed or services performed for your association. And if you don't understand it, then it's a good time to ask them. There's another, it's not a trick question. So, do you or another person look over your association's bank statements and reconciliations each month? And this is anonymous, so you can answer is you really do.
About 15 more seconds, Bill.
Take your time.
Okay, and here are the results.
Page 70, that's even better. 80% look at the statement. That's excellent. That's a great internal control over your association's cash. So, and those who said no, I think you know the answer, that maybe you should look at it more often. So, to the last slide, the solar tax credit, and you first qualify that. If you remember back a few minutes ago, as I told you that your association is not tax exempt, it's not a nonprofit. And here this comes up because many of you have heard of the solar tax credit, and if you're a tax exempt, that you get cash back from the Internal Revenue Service. Well, you're not tax exempt, so you're not going to get cash back from the IRS. So the credit is 30% of the cost for the equipment, the installation, the permits, and so forth. Now, if your association pays for it, the credit is going to have to get claimed by the owners. And the methodology or the mechanism is the association has to tell all the owners what their share of these qualifying expenses are. And they probably would do it in January because that's when everybody does their taxes. So you're going to get a letter from your homeowner association saying that your share of the qualifying expenses were whatever they were, and then you claim that on your personal tax return. Not seeing any association do that, but that's one way you could. What most associations do is the second, which is where you hire an outside party to build and install the solar energy equipment, and that outside party gets the tax credit. In exchange for that credit, the cost for installation and building of the solar energy system is less than it would be otherwise because that contractor got the credit. Next is that the association leases back the equipment from the contractor, and they also purchase the electricity generated by the equipment from the contractor. And after a number of years, there's two things that could take place. One is there's a buyout provision within the lease, and the association goes ahead and buys the equipment, and at that time, they don't make any more lease payments, and they don't pay anyone else for the electricity. Or they don't exercise that option. They continue to lease the equipment, continue to pay for the electricity. It's the second one that hire an outside party to build and install that's seen the most. And many times, if your association's got a parking lot, they install for the parking. They put on the roofs of the parking structure. That's where the solar panels go. So the cars get protection from the sun, and then the solar panels generate electricity for the association. I think at time, I learned just the other day, there's something that's going to affect most homeowner association starting next year, and it's called maybe you already know, it's called the Corporation Transparency Act. This was passed actually back in 2021. It was to be effective in 2024. And what it has something to, it's going to be regulated or mandated through the Treasury Department, not the IRS, but the Treasury Department. At least that's for now. And it's going to require each year that corporations, and that's most associations, corporations have to report something to the department, which is called the Treasury Department. Report to the Treasury Department about who owns their association. And since the Treasury Department hasn't yet issued any sort of form yet to look at, any idea what you're supposed to report, I have no idea what to say just yet. But I believe that every homeowner association is going to have to report annually. There's probably no payment involved, but you're going to have to report each year. So with that said, thank you. And my apologies for the technical difficulties. I hope that didn't stop anybody from asking questions and so forth. There seems to be a lot in the chat.
Okay, so thank you, Bill. So let's go ahead and start talking about, what's in the Q&A. So what we'd like you to do is go to the Q&A section and vote for your favorite questions, and we'll take them one at a time. And yeah, again, we're sorry for the problems with the sound and the technical glitches in the beginning, but I think we got through those. We'll go ahead and begin with those questions. Again, thumbs up. We'll give you a couple minutes for that. Bill, do you have your Q&A up and ready to go? Let's push the most upvotes and we can get rolling.
Oh, okay. I don't know how. Let's see.
I can read them for you if you don't, so that's fine.
Wait a sec. Yeah,
Let me go ahead and ask you the question.
Yes, thank you.
Our HOA has new board members every year, but our management company says they will only file a new Secretary of State filing every 2 years, as you know, that's required by law to do it pay for it every year.
Yes, yeah.
To meet expiration requirements. And what's your thought about that?
Well, that sounds more like a legal question.
Mm-hmm.
I could give you my opinion, but I believe that's more of a legal question.
Yeah, and I will say, and we're not attorneys here, so we can't give legal answers. I do know that a lot of companies do that, and they wait until it's due to go in and change. Maybe not the best practice, maybe not technically correct, but I do know that happens a lot. Okay, when should next question here, so we can get rid of that one. And when should tax returns be prepared? Is it later this year because of California's October extension? What's the usual deadline?
15th day of the 4th month is the date that the returns are due. From our firm, we prepare and file extensions automatically, period. That's that. So, but the regular due date's the 15th day of the 4th month, meaning that if your association's year end is December 31st, that's April 15th, unless the 15th falls on a Saturday, Sunday, or that particular holiday in Washington, D.C., then it's the following day.
Okay, so that sounds good. Our HOA, let's see, this is answered live. Our HOA has a new board member every year. We've done that one, took care of that. For the IRS 70-604 ruling, our homeowners voted to have excess income returned to the owners instead of rolling over. How does this affect which year's budget and years in financials? Is that too specific, or can you answer that one?
Oh, that's a good question. The first part, and I don't think anyone's trying to be cute, is I would not put, and you can look at the wording, don't put in the resolution that the members have an option to either apply the excess or to refund the excess. If you give, you can understand, if anyone thinks they're going to get money back, they probably would vote for it. And yet, from a practical standpoint, it's so onerous and so expensive that you're not trying to hide anything, but you're just really saying, if we have excess assessments, we'll apply it to the following year's budget. Implied is if they say no, that you could, if you want to, you could refund the excess. But anyway, so that's, if you look at the resolution, I would leave it vague, is you're not applying it to any year in particular, because if you decide, let's say when your annual meeting is, if it's in March and the year end of the association's in December, what year are we speaking about? You speaking about the year that it just ended or the year that's going forward? So it's, if you just leave it, don't say anything at all, then you can be interpreted in the most favorable light.
Okay, for those of us that don't know what an IRS 70-604 is, ruling is, can you just kind of give us the summary?
Oh, sure. That says, or the members say that if we, the association, have excess assessments, by that I mean surplus of operating assessments over operating expenses, that if we do have such condition like that, we, members of the association, give instructions to you, the board of directors, that when you're formulating how much our assessments need to be next year, that you please take that into account when you're deciding how much assessments ought to be. That was it.
That's it. Okay, good. And next question here. You say an HOA is not tax exempt. So what does exemption mean?
The exemption is merely for that $800 a year minimum tax. The minimum tax meaning with the Franchise Tax Board, let's say you have $500 of interest income, the tax on that is, say, $50. You have to pay the $800. But if the tax is $2,000, you pay the $2,000. So it's the greater of $800 or the tax computed on a percentage basis. That's the main difference. The other difference, and now it seems to be a lot of interest, is interest income from U.S. Treasury securities. If your association has exemption from the franchise tax, then interest income from U.S. Treasury securities is not taxable. If you lost exemption, then interest income from U.S. Treasuries is taxable.
Interesting. Okay, so thank you for that. Why can't the HOA just deposit any excess revenues over expenses into reserves in order to have a balanced budget and minimize paying taxes to the IRS?
Well, we're putting money in the reserves is not a 7604 election. That's just recognizing that maybe you have surplus money in the operating bank account. It's in the best interest of the association to take that surplus and put it into reserves. But that doesn't address the election that members need to make. They may be related because making the election put a surplus in the operating bank account, but one's got nothing to do with the other directly.
Okay. Next question. So this one's from James. Does approving payment of invoices outside of a board meeting, electronic transmission, violate Civil Code 4910, board members outside of meetings?
Sounds like a legal
Outside
question.
of board meetings outside of.
I'm not trying to worm out of that, but that certainly sounds more like a legal question than an accounting one.
Sure it is. It is. So James, you're going to have to talk to an attorney about that. Sorry for the worminess. Okay, so let's go ahead and talk to Michelin Paquette. And what would the benefit be to use Form 1120-8H rather than Form 1120?
You hit my point of view. There is no benefit whatsoever. There is no benefit whatsoever from 1120H, not only from a tax standpoint, but the 1120H has to be paper filed. So 1120, it could be e-filed, you're going to pay less tax.
So you're suggesting to file 1120 and not the 1120H. Did I hear that right?
Yes, yes, yes,
Okay.
that's correct.
There you go. Next question from Joe. We keep hearing that HOAs are not tax exempt, but per the FTB status page, my HOA is listed as currently exempt from tax under Revenue and Taxation Code. Section.
23701T,
Yep.
that's for homeowners associations. That's why it's very misleading. I heard someone use the word quasi tax exempt, which I can get, but I think we need more like a black and white way of looking at this. So tax exempt sounds that you're not going to pay tax on anything, which is incorrect. So if you say you're taxable, you're going to come up the right answer most of the time.
Okay. So just to be clear, the corporate status is a tax exempt status, but you still have unrelated income that you have to pay taxes on that's not related specifically.
Similar, something like, yes. Yeah,
Okay.
that's similar concept. Yes, yes, that's right. Legally, you may be thinking of as you're called a nonprofit mutual benefit corporation, thinking you're tax exempt, but that has nothing to do with income taxes. No.
Okay, so Joe, there you go. Kay Santos, did I hear Bill say HOA is not a nonprofit? Is Bill going by tax exempt? Again, there's a lot of confusion about this. Bill.
No, that's right. That's the point. That you're better off saying that you are not a nonprofit, and then you're going to come up with the right answer most of the time, than thinking that you're a nonprofit, and then you're going to get to be right once in a while. So I'd rather have a batting average 750 rather than 250. Is that?
Yeah. Okay. So under corporations code, this is like what is it? A 501c4? Is that what most HOAs are?
No, there are maybe 20 associations. That's an overstatement. That are 501c4s.
Okay. So what is an HOA? What is this corporate? What do you establish a corporation under? Which code would most HOAs fall under?
You're called a regular. They're called regular C corps, just like General Motors, IBM, Alphabet, you name it. Regular C corps. That's what you are.
Okay. So they're not under the 501c.
No, not at all.
Okay,
No.
so
In order to fall under that, oh my goodness, you have to apply for it. You have to pay for the application, and it there's very little benefit from doing that.
Okay. So I guess it's to answer this question and confusion, which I had a little confusion about myself, is the
Right.
Yeah, it's not a typical nonprofit under the corporations code. It is a corporation, a C corporation, more like a C corporation, if not a C corporation. It is a C corporation. Okay, so when people say it's a nonprofit, that is a misnomer. That's a misnomer. Then
no,
okay.
no, yeah, they're not a nonprofit. I mean, you might be right 1 out of 10 times, but rather be right 9 out of 10. And so if you say you're not a nonprofit, you're going to be right most of the time.
Right.
So don't. If you start thinking nonprofit, then you're going to come up with the wrong answer most of the time. You're not a nonprofit. You're not tax exempt. I'm only the messenger, but still, you're not a nonprofit. You're not tax exempt.
But you can't make money, right?
What do you make money? You sure you can?
Sure you can. Okay, so that's the question. So you can make it through solar, selling solar energy and
you can make money. You make money on your assessments. Of course, you have expenses. That's why you have the assessments.
Sure.
But it's the other kind of income that you pay tax on, interest income, cell tower rent, Comcast easement payments, you
Okay.
name it, things like that.
Okay, so you can make money and
You
on
bet. There's
other.
nothing wrong with it. You can make as much money as you want, but you'll
Okay.
you just pay tax on it if it's non-member income.
Okay,
Go
so
ahead, you know.
so as a business, you can make some money on and help reduce your costs.
Homeowner associations, yeah, if you're fortunate enough to have AT&T and Verizon and whoever want to put a cell tower on your roof or on your property, great idea. Yeah, you pay tax on it, but it's still better than not getting the money at all.
Okay.
It's a great idea. Do it.
Yep, I think that is a misunderstanding generally. So that's good. I know you can do that. So, okay. Now, anonymous attendee, we have a lot of people in that family. Anonymous is installing an EV charging infrastructure or a solar, a reserve expense or an operating expense. Where would you class that? EV
That's
charging.
an excellent question. And get anybody upset, but it's an operating expense. It's an operating activity because it didn't exist before. You can't take reserve money for something that didn't exist, never turned over by the developer. So it's an operating expense or an operating expenditure, should we say, the first go around. When the equipment gets replaced in 20 years, because then you put in a reserve study, then it's a reserve expenditure. But the first time around, it's an operating.
Yeah. Okay. So if you want to put in a EV charging infrastructure, and I've had people talk to me about putting in, high-speed internet cables and things like that. And you're going to have some money. I mean, you're going to have a significant expense. Can you create an account in your reserve reserve funds to pay for that and say 3 years forward?
That's after no, you have to accumulate it in operating. You're accumulating the money one way or the other. But no, if you put it in reserves, then you're you kind of defraying money that would be good to actual reserve components versus something that you haven't acquired yet or installed yet.
So you put it in the operating budget and just accumulate it in operating, and then once
you special assess it.
Okay.
Most do it as special assessment.
Okay. Well, that's interesting. So there's anytime there's an amenity that's created, also anonymous, the community, you're creating a long-term component, if you will, and then you need to make sure the community is behind you on that too, because it's going to have continuing maintenance and costs associated with it.
You're right. That's right. You're right.
Okay, so thank you for that, Connor. We can move on. Carol Clark, there are 5 people that wanted your question answered. If not able to achieve quorum on the annual 7604 requirement, what do you do?
Yes. Move forward. There's nothing saying one way or the other that has to be a legal meeting to conduct business. It's not anything that is a legal matter. It's a tax matter. I think because how many associations can never get a quorum at their annual meeting? So you could have a member meeting, quorum or not. You just make it as it's a member meeting. You've announced it as such, and you can conduct the election.
Okay, so that makes sense. Yeah, that's a regular question, and I think the legislature is dealing with that issue as well for elections. So trying to reach quorum because it's too difficult.
Very hard.
It's very difficult to get a homeowner quorum, especially since so many people, especially in California, have homes in other parts of the world, and they just have this place to stop over in California. So it's a second home or an investment. Okay, and does the SI 100 and the CID form have to be filed with the Secretary of State every other year, what's a SI 100 form? I guess that's the first question.
That's
And will the
statement of
second
information.
statement?
SI 100 is
Oh,
a
oh,
statement of
sure.
information.
Okay.
Yeah. The FICID is one for common. If you're a corporation, you have to do both. If you're unincorporated, you just do the CID. And
Yeah,
I
okay.
believe it's every other year.
Okay. So the SI 100 has to be filed. I think it's every 2 years, right?
That's right. Yes.
Yeah. So it's every 2 years. And will they send a reminder? Depends who's the person. Well, answer the question. Okay, sorry.
Oh, I'm not sure about that. I don't know.
Okay.
Actually, it's
My experience is that usually whoever the agent is gets a notice once every other year. So and normally it's the management firm. So
Yes,
they should be
true.
they should be notified. But you can double check that just to make sure I'm not off. That's my understanding though. And if anybody else has the answer to that, that's done it before, or that's on the call still, we'd be happy to hear from you as well. Okay, let's go to the next question. Again from Anonymous. Please discuss the taxability of foreclosed units and the issue of basis.
Interesting question, because I just saw a tax return that I'm going to disagree with the presentation. Foreclosed units. An association acquires a member's unit because they couldn't pay their assessments. So let's just throw rent. You didn't rent it out. You just foreclosed and you held it, and then you turn around and sell it at a later date, and you sell it for more than the less of the unpaid assessments. I believe that's how the question's being asked. Is that gain, if there is one, in other words, you sell it for more than the delinquent assessments, is that taxable? My point is that it is not. It's member income. It's not non-member income. Or if you are fortunate to sell the foreclosed unit for more than the unpaid assessments, then it's not taxable.
Okay.
That answers the question.
Okay, so that's good. I'm looking, we have a lot of questions still in the queue here, so I'll try to speed it up a little bit. Let's go again, anonymous question here. We want to keep the dues the same this year since all expenses are about the same. Well, that's kind of unusual with inflation. But different unit types pay a little more and less, even though the total membership income is the same. What's the question here? How to avoid this, more or less?
Well, there was an association, I won't name or anything about it, and some of the assessments get divided equally on a percentage basis. One of them was insurance, and the rest of them didn't. Well, they formulated their budget and they kept assessments the same, but the insurance went way up, and I don't know, they did something, probably the reserve contribution went way down. So assessments stayed the same. And the board president announced at the meeting that everybody's assessments would stay the same. He forgot to mention that it's not the total assessment, it's the individual assessments and how those are determined. If you have a division of assessments on the mixed or super mixed method, then even though your total assessments stay the same, individual assessments likely would not, unless all the expenses stay the same as well.
Okay,
That
so let's
answers the question.
let's move on. I think that's it's reasonable.
Okay.
I think it's a risk when you don't have an assessment collected each year. It's you're asking for trouble over the long run, except for very small associations. How is the surplus recorded? Description on the balance sheet, which section?
Not on the balance sheet. It's on the surplus is not on the balance sheet. It's sitting in cash in the operating bank account, the reserve bank account. But you budgeted for it, and on the budget, you would put in the revenue section. You could say carryover surplus or excess assessments prior year, something like that, and you put an amount in there so that everybody's happy when revenues equal expenses. Question?
Okay, that was pretty clear, Anonymous attendee, question. We have units with high delinquencies going into year 3. It's $50,000. It's going to go through collection. How should it be reflected in the budget? How should it be reflected in our prior year financial statements and our prior financial statement, or should we not? When the $50,000 delinquencies come in, we don't want owners thinking was fraud because it wasn't documented. Question.
That's an excellent question. You're kind of mixing up two things here. One of them is the annual financial statement, and the other is your budget. In the annual financial statement, probably there was an estimate called an allowance for doubtful accounts, where the CPA made an estimate of how much assessments were impaired and made an estimate of how much of those uncollected assessments would be uncollectible. So comes along in your budget. If you budgeted for a bad debt expense, then you're fine. So it comes along now in the current year. If you're fortunate enough to collect those previously thought to be delinquent assessments, then I think the expression is found money. I wouldn't. One, you're not going to budget for it. Two, if you do collect the money, it's just you have a budget. You have a surplus in the next year. That answers the question.
Yeah. But what if you place a lien on those doubtful accounts? How do you manage that?
So a lien, and then they pay them off, and they'll release the lien.
So if they don't, so if you have
doesn't have anything to do with.
Well, if you have a lien, if you put a lien against the doubtful account and you sell the unit, and you have somebody sell the unit, then that'll cover the cost of the doubtful account, I assume, and then the rest would go to back to the homeowner, correct?
I don't know. I think if I've not seen one where the association sold a unit out from somebody and gave them anything that was left over. There's not going to be anything left over. They pay off the mortgage, they pay off the delinquent property taxes, they pay off the association's assessments, and then I don't believe there's going to be anything left after all that.
Yeah, gotcha. All right, so let's go to the next question. Hope that answered, at least partially answered your question. Stephen Jaffe, we have been told by solar installer that the rules changed and that we can, as an HOA, get the 30% back from solar expense back to the HOA. So 30%. I think
wrong. That's wrong. Because it gets back to the change. You're partially correct. Yes, they did change it to say that if you're tax exempt, the IRS says a tax exempt, that you can get the money back. But as I said, the associations are not tax exempt. You don't qualify to get that money back. Unfortunately, you don't. Your options are the ones that were discussed, not to get money. The association's not going to get any money back.
So Bill, can an association form a tax exempt HOA nonprofit?
Oh,
Under
I don't think as what would it be? How could you to do what?
To run the solar energy to roll the solar energy program?
I can't imagine that the IRS would approve such a thing. I don't know. I've never that's a new one. I haven't heard that. But
just thinking.
Well.
Okay, so let's go to Earl then and see what if we don't get an annual review within the 120 days required by David Sterling, what happens?
Well, everybody loses their house. It was supposed to be a joke, nothing. Nothing happens to anybody. No. What happens though to a board is that at the meeting, somebody shows up and embarrasses the board by saying, where's our CPA financial statements?
Yeah, and there could be some disclosures issues that you have
Yes.
if there's a
Yeah.
new
Yeah.
buyer and you say, well, we haven't
Yes,
asked
definitely.
for it,
Mhm.
and you don't have it,
Mhm.
that's a problem. Okay, so let's go to the next question. Carol Lawrence. Also, she didn't put a complete address, and so mailing, I don't know if this is a continuation of something. So mailing address is for the entire building address, but there is no mailbox solely for the HOA. So the postal CXR, I don't know what that is, has nowhere to deliver. Carol, I don't know what this means. I don't know. Bill, do you know what this means? I mean,
No idea.
okay, let's move on to Ed Yuli. I assume our treasurer reviews the check register, but don't really know. How can we ensure someone is doing this?
I need to laugh. That's a good question. You can ask them at a board meeting, and that's what more could you do? Or you should do it yourself.
They're actually,
those are your choices.
well, there's one other choice, Ed, and that is that there is software now out there, and you can actually see if it's been reviewed. I mean, you have to push a button, but there is some of this automatic new software, and you can do that. And it's not everyone that does that. Some of it's mobile enabled as well, so you can do it from your phone. The other thing is that you can have it go to the entire board then. So there are systems that are being developed to try to make it easier and more efficient for boards to manage their financial affairs. Believe me, there are a lot of fraud and not, I mean, compared to the 54,000 HOAs out there, there's not a lot of fraud, but there is that risk, and you need to have control over those fundings, the funds flow, and make sure you do that. And the law now requires, I think, to approve any expenses or any movement of significant amount of money from one account to another. So you need to do that too. So I hope that helps. Let's go to anonymous here, attendee. Okay, we're back to the 7604. Is using 7604 in 1 year, does it make it taxable in the next year if there is excess assessment in the second year, or can the second year 7604 apply to the prior year?
That's a good question. You hit the nail on the head as far as the controversy goes. And this is just one opinion, and that is that the associations can elect a 7604 election annually, not just one time, annually, and it applies to each year. So you can elect it every year, and if there's a surplus, it's not subject to tax.
Yeah. All right, so this is we're coming on the it's 2:24 now. I'm going to go ahead and push this until at least 2:30 to answer questions and try to get as many of these in as possible. Then we'll do a wrap up afterwards, especially since we had a little bit of delay. And I do know that Connor and I will be staying after a little bit. Bill, I don't know what your time availability is, but maybe you can stay a little longer to try.
I'll stick around, sure.
After the wrap up. So, okay. So again, we try to get as many of these in as possible. Okay, here's anonymous again. Our HOA has excess income generated from residents renting out the community room for events. The income is more than what the HOA needs for its maintenance and reserves. Will the excess income jeopardize the nonprofit status? If we answered that, it's not.
You're not a nonprofit.
Yeah.
So there's nothing to worry about. Since you're not a nonprofit, don't worry about it. I'm not trying to be facetious, but you're not a nonprofit. I know where this comes from, but you're not a nonprofit. So you can rent that clubhouse out all day long. Great to do so. If you rent it out to non-members, it's taxable. If you rent it out to members, it's not taxable. So don't hesitate to rent your clubhouse out.
There you go. That's yeah, it's a way to make some money and keep your assessments down
Sure.
if you have that ability. Just make sure you have the appropriate insurances and agreements with the community. Okay, anonymous attendee, another question. Any grants or tax credits available to California HOAs for EV charging installation? Do you know of any tax any programs for solar or EV charging stations?
Yeah, I think there is something out there. You have to go look at PG&E's website.
Yeah, there likely is somebody else that's in the meeting might know of. There's some clearinghouses out there. I do know that, and we've had a couple of programs on both of these topics, and they do talk about tax incentives and grant programs. So there are some out there. I heard they got tighter of late, but with the funds, but somebody may be able to answer that question and put it in chat. If you wouldn't mind putting it in chat, the place to go look. So we'll just go ahead and try to do that. The other thing to do, if you're a member, you can access a member of ECHO, you can access our programs and go ahead and maybe pull up those two topic areas, and I think you'll get an answer. Or use Google. Google's always good. Okay, Kay Santis. Dave Connor, any chance ECHO can clarify what happens when the CCNR state we are a mutual benefit nonprofit? I'm guessing that that's the case for many HOAs.
Hopefully it is, but it has nothing, absolutely zero to do with taxes. Nothing, zero. As I said, that's part of the confusion that comes about. Doesn't matter what those CCNRs say. For tax purposes, your association is not a nonprofit. It is not tax exempt. If you keep that in mind, I say you'll be right most of the time.
Yeah, and part of this, I think, is that I think causes the confusion is that the agency that establishes your corporate status is not the same. It's not the same.
Secretary of State.
As well as the Secretary of State that's doing that, and federally as well, the IRS that is going to establish that. And then you have what your governing documents say, and that's done differently. So you can say anything you want, I think is what you're saying, right, Bill? In your governing documents.
Your governing documents say things for a legal purpose,
right.
But for taxes, they don't. The tax authorities don't really give a darn, pardon the expression, about what your governing documents say. You're a C corporation. That's that. So
there you go. So you're a C corp, and then you do things, you do activities that you may be generating some income off of that's taxable. What your governing documents are then saying is, well, number one, from a tax perspective, you have to pay the taxes on it. But number two, it's saying your governing documents are saying we don't want our company, our HOA, to make money. So we need to be we need not to have that income, and so you probably need to talk about maybe amending your governing documents to allow that. But that's a legal question. I would run it by an attorney for sure. Okay, so she says she completely understands what you're saying. But okay, Steve Rubin. Hi, Steve. How are you? Small associations do not have luxury of large operating funds availability for adding solar or EV stations in a single year. How can small associations legally amass the money to add these assets?
Get a loan, special assess. That's where you'd have to get the money.
A loan, a special assessment. Can you establish a sinking fund or like a savings account for this stated purpose? Yeah, so you could.
But as I said, but most associations, they go and they're not out of pocket. They have a third party contractor build and install the solar energy equipment, And the contract, the third party is the one that gets the solar tax credit. The association does not.
Right.
Once the installation is done and running, is the association purchases power from the contractor at a lower rate, I believe, than what you pay PG&E, and also pays the contractor, we call a lease payment, so that over time, the association has the option to acquire the entire solar energy installation and then stop paying not only the lease payment, but stop paying for the electricity.
Okay, so you can establish, and what I'm hearing, Steve, is that you can establish a savings account. Oh, I used to call them a long time ago when I was doing accounting, sinking funds to put money away, stash money away, so that at some point you're planning on making an investment in your community. So you can create that fund and then spend it at some point. I think you need to be pretty transparent with the community to make sure they understand where the money's coming from and what the purpose is. But other than that, that's not a bad way to do it. We've talked about that. I've talked about that with other HOAs in California, and because this is something, and one of the new twists that I'm hearing today is that if you rent out your clubhouse and you're making a net margin on that, you could designate the profits from that operation to the sinking fund so that you can do something, add an amenity. So those are, I mean, so you as an HOA, what I'm hearing today, and this is a good conversation, is that the HOA needs to be run more like a business, and you do have options. You're not as limited as you think.
Absolutely. Yeah,
okay,
definitely.
let's go to Carol Lawrence here. Okay, Carol, okay, a rather long one. I did not run for the board, but my name was listed as an agent of service. I asked the property manager to remove me. She filed several different forms that just made matters worse. So finally, I went in and looked at the history of and saw several years ago a property manager resigned as agent of service, and that form does not require fees. So I did that herself. I do not want to be served. As she's not on the board, I think is what she's saying. So so I guess there's a way to do it to get off being the agent of service. So and that's something the manager should do for you. But if you if you can do it, do it. I mean, you have to look out for yourself on this stuff. Charles Kaufman, is there any restriction on changing the reserve contribution on an annual basis?
No, there's not a restriction whatsoever. You can put as much or as little as you want. Well, I wouldn't go as a little. There's the running of if you're under 10% of your assessment, less going into reserves, then it runs into question, I believe, from getting from members or potential buyers getting bank loans. But no, there's no restriction. You can increase what's going in reserves 100 times. Doesn't matter. That answers the question.
Yep. Okay. I think I'm gonna ask Connor to pull up the final slides here, and I'll go through the final my last few comments, because they were after. It's 2:34 right now. Bill's going to stay longer. I'll stay longer and answer questions. But let me just get into the concluding remarks here, because I want to say thank you to everyone who has attended today. And I want to say thank you to all of our supporting sponsors, and of course, Bill, for participating. As a special gift for attending this event, we will be providing a copy of the Condo Green Book to all attendees, provided to us by Bill Erlinger of Levy Erlinger Company CPAs. Thank you, Bill, for doing that. We would very much appreciate it. It is it's the online version, so it's the
Exactly.
and it is the standard in the industry. So that's quite a nice gift. So thank you. This one-stop resource for all association financials is a must for your association treasurer or board. To get your copy, keep an eye out for the post event email. You're all going to get copies of the slides. So Connor will be sending that all out to you in 7 to 10 days. So you will be getting a recording as well. You will receive the link. Just click on the link and download the copy for yourself and for your board. Do it quickly because there is a limited time. I don't know what the time frame is, but that link will only be up for a short period of time. So be on the lookout for that. For those of you who are not ECHO members, please consider joining and becoming a member of ECHO and supporting our HOA boards throughout the country. To join, simply go to www.echo-ca.org and click on the membership tab. For ECHO members, I want to say thank you again, and really thank you very much for supporting us. And please invite your friends, boards, and especially management firms and vendors to join ECHO. A simple invitation is often all it takes to encourage someone to join. If you would like to become more involved with ECHO, we have a few opportunities for you. Please refer to the slide. If you see anything that looks interesting, please send me an email and I'll be happy to discuss it with you. We right now really need some moderators for the board members club, and they don't have to be, they can be the substitute moderators as well. So we are a little short there. So we'd like to put a special call out for that. And now for some other announcements about events. Our Wine Country Resource Panel will meet in person on September 5th from 11:30 to 1:30 p.m. at the Roanoke Park Branch Library. We will be discussing association insurance, reasons for denials, unbearable costs, the strategies for proactive boards to overcome these difficulties. This is a huge issue and one that needs to be dealt with in a strategic way. So we're hoping to have a really good conversation there. The next ECHO Board Members Club meeting is September 12th. It meets via Zoom every second Tuesday of the month from 5:30 to 7 p.m. This is statewide. Next month, we are continuing our management success theme by following up on the management selection process, which was last month's or this month's topic. Next month, we're going to have a conversation of how to ensure the success of your new management decision. The Board Members Club is open only to ECHO members who serve or have served on the HOA board. These highly interactive peer-to-peer learning experiences are scheduled from 5:30 to 7 p.m. and are Zoom meetings. Just contact Connor and he'll get you set up with the application. You must apply. We do have rules for the Board Members Club. You have to be nice and not angry at other people. So that's the principal one. Once again, thank you to our sponsors for making this workshop possible. And thank you again to Bill for developing and presenting the material. And of course, thanks to all of you for attending today and making this a successful event. ECHO appreciates your investment in education to foster a better quality of life in HOA communities. I want to say thanks to Connor, and he has a few closing remarks, but in closing, as I leave, I want to say I apologize for all the sound issues in the beginning, but I'm glad that everybody had comments to help us get through it. So thanks, Bill, also for being flexible there.